So Warren Buffett once said, you gotta invest early, invest often, but most importantly, his biggest hack on he got billions is you need to compound your investment, which means any kind of money you're making, passive income in crypto will be staking. You gotta take that money and put it back into the market so you compound your money and your money grows faster exponentially. In today's video, I want to talk about how to build a long-term portfolio, and I think this is the best time to start investing into the market. So if you have no money invested and you never got into investing, this is going to be one of the best times ever. You'd rather get investing now when the markets are down, and yes, it might be scary because all the headlines are talking about market crashes, we can go lower, recession, and sure, we could go lower. But if you follow this strategy, I promise you in the long term, you're going to be thanking yourself. And 80% of the best days to trade in the market and to buy, the best buying opportunities have presented themselves in a bear market. So out of 100, the 100 best days, 80 of those are during a bear market, which makes a lot of sense because if you buy the bottom, when things go up, you're going to make the most amount of returns. And the study shows that actually if you bought only 30 of those days during a bear market, you'll be over 83% more in profits than somebody that didn't buy those days. And the study goes back around 30 years. Now, it doesn't mean that if it's on a bear market, you shouldn't be investing, but it just shows that if you start investing in a bear market and you take advantage of those really red days, it actually makes a lot more gains in the long term. So in today's video, I'm going to be showing you guys how I build my long-term portfolio, and then you guys will be able to just copy every single thing. And I will be using a pretty cool app. It's called M1. It's not sponsored by them at all, but it lets you invest in the form of a pie, so you can give a percent to how much you want to invest in a certain asset. And the really cool thing about this and why I do when I use this and show you guys is because I can actually share my pie. So let's say you want to copy and paste it. The link will be down in the description below, so make sure you click it, download the app. Of course, it's free. There's a $50 referral bonus if you do sign up with it and you putting $100 in it. Like I said, it's not sponsored, but we'll be putting that down below because I know you guys always ask me, Antonio, can you trade for me? Can I give you money? Can you invest for me? Just take my money, make it grow. And the answer is always and will always be no. I will not do that for you guys. I can't do that for you. It's illegal unless you guys want me to go to jail. So I will not do that. But for educational purposes, I will be showing you guys how I'm building my portfolio, and I'm allowed to share the pie. So it'll be down in the description below, just so that you can look at it for educational purposes only, not investment advice. And just so you know, if you're building a long-term portfolio, you don't just want to invest in stocks. There's of course crypto, real estate, other ventures you can get into. But for this video, we will be strictly stock market. So now we're going to get M1 real quick. I'm going to show you guys that you have a pie style type of setup. You have target of percent, so you can give as much or as little percent as you want to certain stocks. It also has a really good way to add slices and find tickers. It shows you market cap, it shows you the top tickers for a certain sector. And we're going to start this off and we're just going to get this over with. The vote. How much are we going to invest into the S&P 500? The most boring out there. I just want to get it done, and we'll add about 25%. That's how much I like to have invested into the vote. Anywhere between 25 to even up to 50%, if you're going to be on the extra safe side, is totally a good option. Next up, we're going to invest a big chunk or a decent chunk into two main tech companies. And those two main tech companies are just giant techs, which are Microsoft and Apple. We'll be torn on which one I want to give more to what. I do believe Apple has good growth, but I do believe Microsoft might have an ace up their sleeve, which is speculation on my part, which maybe they might be acquiring Netflix at some point in the future, which I think will be great for their market cap and for investors like me and you, for them to buy Netflix. And the main reason I say that because a lot of those other tech companies, they already have, Apple has their Apple TV, Apple Music, Amazon has their Amazon TV thing, and I think that Microsoft is looking for somewhere to get into that business. And Netflix, they've been losing subscribers, they're struggling a bit, they might be able to acquire. So for this purpose, I'm gonna go with 8% of my portfolio into Microsoft and 7% of my portfolio into Apple. So right now I'm focusing on the tech sector because it's going to be our biggest slice, and in the long term I think we're going to see the most growth out of these sectors. Going to go with some chips, microchip companies. We're going with both Nvidia and AMD. The Senate is going to pass the bills for the chips to just keep growing. So we're going to go with 3% on each, which totals to 6%. You can also go with 2% AMD, 4% NVIDIA. I'm stick through 3 on each for today. Next up, we're going to go with one of my favorite tech companies, which is Google. I do think out of all the tech companies, Google offers just great investment opportunities. They have a ton of cash in hand. They have just safe balance sheets. Their ad revenue, whenever the bull market is back on and companies can spend more money and we're not in a recession, their ad revenue is just much more than any other companies, more than Facebook, Instagram, TikTok, just because they take up not only just Google, but YouTube as well. They recently had a split, so it makes it very nice for everybody to get it more affordable. I usually don't like stock split, but what can we do? I can do much about it. Give us a nice dip opportunity very recently, and I'm going to take advantage of it. I'm going to go with the big 5% into ticker symbol GOOG. Next up, we're going to go with Amazon. I'm not huge into Amazon as many other people are, because I do think they're going to lose a lot of those market shares. A lot of people are not talking about Amazon on their last quarter report actually reported a negative year-over-year growth, which means people are not shopping them as much as they were. And I do think that trend is going to continue going that way. Amazon, if you look at a 5-year chart, it just hasn't seen the growth as many other companies. I think investors are starting to see that. So I'm actually going to go very small here with about 1% invested into Amazon. I do think they're a great company. I just don't love their long-term growth. Next up, we're going to go, again, another tech company, Tesla. What do you do about Tesla? Either you hate it or you love it. They changed the market. They are, to a certain degree, overvalued, but I do think they're doing innovative things that many other companies are not doing. So for that reason, I do like Tesla. I bought some Tesla in the 600s recently. I did buy, my last buy before that was last summer in the 500s. I first bought Tesla before the split, when it was around 200. Remember, they went to 2000. So I'll go about with 3% invested into Tesla. I do think long-term growth is there. All right, now we're going to start investing into a different sector. We're done with some of the tech. I'm going to leave the growth stuff at the end, and we're going to go into consumer staples. It's going to be your Costco, your Walmarts, your Targets. So now they're getting hit hard by a recession. We saw a lot of those actually report really bad earnings, which made them crash. And I actually love that. We're building portfolio now. Great time to scoop them up. Now, a lot of them are rebounding. They're doing much better. But we're going to focus on only 2 out of those major consumer staples. And that will be Costco and that will be Walmart. Walmart, why? Because they do really well with lower income areas and their biggest consumer staple in the U.S. And I did have some of the best revenue out there. Of course, Costco, great growth, great business model all around it. I'm going to go with about 2% in both Costco and Walmart. And now in our consumer staple, they could also be in our dividend category. I'll just throw it in here. It's Coca-Cola. They offer great dividends. The growth just isn't there, but I do think it does play a part in the portfolio, which is very important. And I'm going to throw them a 1% stake. Our last 2 will be Lululemon and Nike. I think both are great companies. Nike, of course, also has decent dividends. Lululemon offers more on that long-term growth. Nike's been there, done that. We know what we're getting with them. But I just do think the business model, and just walk inside Lululemon, now during a recession, they won't do well. But once people have more money to spend, they're doing really well. Just think about every time you go into Lululemon. Have you ever seen empty, even with those crazy prices? And it's kind of like the whole world is moving to more of just a healthier ways of living. I just think that Lululemon is attacking the right market. They're in the right areas, and I definitely do want a piece of them. Not a lot. Of course, we're going to throw 1% to both Lululemon and Nike. And lastly, for this category, we'll give 1% to Home Depot. Now we'll move into our dividends. I don't have a lot of dividend stock that I really love. Again, we're focusing more on the growth. Now, if you're not trying to focus on growth more and you do want to focus more on dividends, feel free to add more percent of your portfolio. 2 days, we're going to throw both 1% to TNT and 1% to Johnson & Johnson. Now we're also going to throw 2% for P&G, another great dividend stock that long term I think is going to pay us well. We're going to throw 2% into them. Now we're going to move on to financials, and I think where the good time to buy financials is currently as we're getting our higher interest rates. I think once the financial sector starts reporting earnings, which we saw Goldman Sachs reported really good earnings last week, JPM and Bank of America, kind of following those, I do think that they can see a lot of growth in the near future, as they did get hurt a lot by those really low interest rates, as they were not bringing more money in. Of course, we're going to go with JP Morgan, my favorite of the financial sector, and we're going to give them 2%. We're also going to go with some Visa. You can also add in some Bank of America, in there. Goldman Sachs is another good options, and we're also going to go with the whole pretty much financial sector. Financial, I don't think a lot of the individual stocks do as well. So I do prefer to invest into the XLF, which is it follows the whole financial sector. So we're going to go with 2% into JPM, 2% into XLF, and then 1% into Visa, as I do when I be invested into the Visa sector as well. Now we're going to be investing into energy. Now energy is really interesting because I believe they're near a peak, so don't want to go too crazy into energy right now. You can go into some tickers like XOM, CVX, and another few options. I'm going to stick to just right now the energy sector, which will be XLE, with throwing in 2%. Now we're going to dive in a little bit into healthcare, and I do think healthcare is going to have a nice rally during a recession. So I might want to go a little more heavier into healthcare currently compared to as I would in a different type. So we're going to go with about 4% in, and we're going to UNH. There's not a lot of tickers that I love in the healthcare, so we're going to go heavy into this one ticker. Now we're going with about 2% invested into gold, a precious metal. The safe bet is gold. I also would like to add some silver. We're going very small with silver and only about 1%. Now to round up our boring stock, we're going with 2% into Berkshire Hathaway to investor boy Warren Buffett. Now let's have some fun with certain growth stocks. I know this is probably what you're here for. We're going to start off with PLTR, a good company. They make their money from the US government, and year over year, they just get more deal done with the US government and private security companies, which I think it shows great growth. And anything under $10, I do like it kind of currently where it's hanging out right now at. And I'm going to go with about 2% into PLTR. We're actually going to go with another ETF, and you might be thinking, what the heck, an ETF into the growth section? This is actually a growth ETF. With a lot of growth companies, you just won't be able to catch them because you don't know who's the winner versus the losers. There might be 100 players, only 2 of those might come out on top. So sticking in the ETF is actually a better option, and we're going to go with about 4% invested into this higher growth ETF. Now we're going to go with Coinbase. I do think as much hate as Coinbase gets, they're actually quite safe a broker. They have more cash in hand than they have debt. So now since they've sold themselves to the government, which a lot of people might not like, it actually might be good for their long-term growth. They're one of the only brokers that is listed on the NASDAQ, and actually getting audited every single quarter and them having to report earnings makes me feel safer to invest into them. Now, if you're very much invested into crypto, you might not like this pick, but I do think they have long-term growth. From where they are now, they're on the $70 marks. I do definitely think it's a decent buy. Of course, if it was back in the 400s, I would have totally hated it, but we're going to go with about 1% of our growth section into Coinbase. Then we're going to add ticker symbol SNOW. I do think that Warren Buffett is actually invested into this ticker. We're with about 2% of it. I do think it's a good company. They have good earnings and really good growth potential. Now we're going to dive a little bit into 5G. They're one of the only companies that are allowed to do 5G currently, and it is Qualcomm. Now you could throw this into the blue chip section, growth section. Doesn't really matter too much, but we're going to give them 2%. And that pretty much runs up our all portfolio, and I'll probably be changing it at some point as things just kind of move in the overall stock market. So I might add some things, I might remove some things, so make sure you keep up with it. You click down the link below in the M1 section that you can just follow it and without having to really do anything. You can just check on it. It'd be really cool to see where we are in a year to 5 years from now. The cool thing about M1 is that you can buy partial shares, so you don't have to put exact amount for each share to stay invested. As always, videos like me take me a long time to make, so I appreciate a comment, a like, a subscribe. Helps us, spread over the channel, get other people invested to learn more stock market, get financially literate. And as always, peace.